Over the last few years, investing has felt anything but straightforward. We've seen sharp market falls in a short space of time. Think about the Trump tariffs. Assets many people relied on for stability haven't behaved as expected, and the headlines have been loud enough to make even sensible long-term investors question whether they're doing the right thing. That uncertainty feels very different as you get closer to retirement. When you're still working, market movements are easier to ignore, but once your investments are funding your lifestyle, a fall in value isn't just a number on a screen. It can feel a bit personal and it feels risky. So the question is this: as you approach retirement, how do you build a portfolio that gives you the best chance of success without constantly worrying about the next market crash? The first risk is volatility. Volatility is simply how much markets move up and down over short periods of time. So you might get 8% one month and then down 15% a few months later. That movement, not the long-term average, is volatility. So cash isn't volatile. £10,000 in a bank account, still £10,000 next month. Shares are different. That same £10,000 invested in the stock market could be worth $11,000 in a good month or $9,000 in a bad one. Over the long term, shares tend to grow far more than cash. But in retirement, the short term suddenly matters a lot more. This is where sequence of returns risk comes in. It's usually the biggest fear people have as they approach retirement. So what if I stop work and the market falls straight away? What if I'm taking income at the same time as a major downturn? In retirement, it's not just what returns you get that matter, it's when you get them. Strong returns in early years tend to make retirement feel a bit easier. Poor returns early on, while you withdraw in income, can cause damage that's hard to undo. To make this real, let's look at history. If we take a 100% equity portfolio, so a simple market cap passive approach, and look back over roughly the last 70 years, we can see how it behaved in some of the worst downturns. Some of the earlier figures are simulated, but they give a good sense of how markets have actually moved. So during the 1973-74 crash, that portfolio fell around 38%. It took about 21 months to fall from peak to bottom, and then another 16 months to recover. So in other words, roughly 3 years just to get back to where you started. In the early 2000s, during the tech crash, the fall was similar, again around 38%, but the recovery took much longer. About 29 months down, and then another 29 months to recover. So nearly 5 years in total before fully recovering. And that's without taking any income. When you're still working, market falls are uncomfortable, but rarely dangerous. You're earning, you're contributing, and even lower prices can even help you. Retirement flips that completely. You're no longer adding money, you're taking money out. And selling investments where markets are down is one of the quickest ways to weaken an otherwise solid retirement plan. A diversified portfolio may fall less, but if you draw in income, the pressure is still there. What really helps is some structure. This is where a proper buffer comes in. A portion of your portfolio held in something stable and predictable and not tied to day-to-day market movements. Think of it as an emergency fund for your retirement income. As a rule of thumb, I like to see around 3 to 5 years worth of planned withdrawals held in lower risk assets. Not because markets always fall for around 5 years, but because it gives you options. For example, if your state pension covers £1,000 a month and your spending is £4,000, you need £3,000 a month or £36,000 a year from your investments. 5 years of protection is roughly £180,000 set aside in a more conservative, defensive type of asset, like bonds and fixed income, or even cash. That money isn't there to grow, its job is protection. So in summary, you can't control market volatility. You can't control the order returns arrive in, but you can control how exposed you are to it. The second major risk is inflation. It doesn't really make headlines, it doesn't feel that urgent, but over a long retirement, it can quietly do more damage than a market fall. After a difficult period in markets, it's very natural to want safety. More cash, more defensive assets, fewer ups and downs. On paper, everything looks stable. And emotionally, it feels reassuring. But in the background, something else is happening. The weekly food shop costs more, energy bills creep up, insurance renewals jump, holidays and meals out feel noticeably more expensive, and that's inflation. And the real danger is the compounding. At around 3% a year, the cost of living roughly doubles over typical retirement. And if your portfolio isn't growing fast enough to keep up, your spending power quietly erodes year after year. This is where many retirement plans struggle. When I stress test retirement plans, one of the key tests is inflation. A plan might look fine, assuming inflation runs at 2.5% a year, but increase that by just 0.5% to 3%, and that picture can change. Spending rises faster, more has to be taken from the portfolio, and then a shortfall can start to appear later in life. 0.5% doesn't sound like much, but over 20 or 30 years, it really is. Many people focus so much on avoiding short-term market falls that they sacrifice that long-term growth. They reduce volatility, but in doing so, leave themselves exposed to a slow, steady loss of purchasing power. And that's why growth still matters in retirement. The third risk is behavioral, and this is often the most overlooked. On paper, some people could afford to take a lot of investment risk. If your spending needs are small relative to the size of your portfolio, the maths might suggest you can hold a very high portion in equities. From a spreadsheet's perspective, that might be fine, but retirement isn't lived on a spreadsheet. It's lived in the real world, with real emotions, real fears, and real memories of past market crashes. If you lived through previous downturns and found them stressful, it's completely reasonable to say you don't want to repeat that experience in retirement, especially when you're no longer earning and you're drawing an income. This is where portfolio design has to reflect who you are, not just what the numbers say. Sometimes holding a little more in steadier and safe assets isn't about financial necessity, it's about peace of mind. That emotional buffer can help you stay invested when markets fall, rather than reacting at the worst possible moment. It reduces the temptation to make decisions that feel right in the moment, but cause that long-term damage. Forget generic rules of thumb, forget default allocations, start with your income needs, make sure you have enough stability to ride out market downturns, and make sure you have enough growth to protect your spending power. And lastly, be honest about your own comfort level, so your portfolio works for you emotionally as well as financially. And if you'd like help putting this into practice and building a portfolio designed specifically around your retirement, feel free to get in touch. Thanks for watching, and I'll see you next time.